Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets Forum, where we check in on the market open in Asia and take some stock of where things may travel through the day. Let's kick off with Mr. Robin Mills, CEO of Qamar Energy. Robin, welcome back to the table. I'm starting to move away from my long-held position that journalism would never be deposed by artificial intelligence, but with the headline, oil prices edging lower amid doubts over US stimulus with rising COVID-19 cases, I'm starting to think that probably robots could be generating these headlines. It's a bit like Groundhog Day. This same narrative just keeps going on and on and on.
Yeah, indeed, Sean. And, with the exception of the vaccine bit, we've been having a very similar conversation since, April or May. This constant tension between economic stimulus and recovery and progress on fighting coronavirus. And I guess the new-ish element from whatever November, December has been the vaccines.
And we're $10 higher, I suppose, one has to acknowledge, from the second half of last year.
Yes, 10 months of activity to get $10 higher, I suppose. So we're gradually creeping up there. But yeah, look, it's the same tension, isn't it, between the severe surge that we're seeing in the US, in Europe, some returning cases in China, which is worrying, versus the vaccine. And I think that the signs on the vaccine rollout is okay. Long term, it's positive, but definitely, I'd say pretty much everywhere that's having the vaccine rollouts is seeing teething troubles, logistical problems. I guess it's becoming apparent this is going to be a longer slog to getting to a high level of vaccination than we might have hoped. And of course, this new variant or new variants in different parts of the world has been the wild card since December, and probably a large part of it behind this surge in cases. And can we vaccinate fast enough to get ahead of these new variants?
How far ahead of the reality? I mean, this is part of the 2020 narrative that the sort of euphoria in the financial markets was well ahead of the sort of real economy. I'm wondering, from your perspective now, at the beginning of 21, given those vaccine challenges, how far ahead do you think euphoria is in front of the reality of where the rollout is, and hence the sort of basic premise of 21 that the first half will be a recovery to get this vaccinated, second half will be rocket to the moon? Do you subscribe to that? How is the narrative changing, do you think?
I think that's still largely the view, and I think we're not seeing the same exuberance in the oil markets that we're seeing in the equity markets and a lot of other markets. I think the oil market remains relatively sensible and restrained. I don't think $55 is a crazy price at the moment. And I think that the idea of a kind of a second half rocket to the moon's maybe a bit too much, but a solid recovery in the second half.
Well, 6 million barrels a day of oil demand recovery in any given year is rocket to the moon. Maybe not this year, but ultimately that's the forecast.
Yeah, sure. But that obviously is coming off such a low base. I mean, if people just start taking flights again, there used to be 7.5 million barrels a day of jet fuel demand, right? And the low points we were down at 2.5. So you got 5 million of recovery right there. Even before you're adding in road travel. So it's and we're not going to be back to 2019 levels this year. Nowhere like it. 2022, depending which forecast you look at, we might be getting back to pre-pandemic levels.
Let's bring in Leo Tameeris from Singapore, CEO of NRG Global. Leo, good morning. Welcome back to the table. Happy New Year, I should add as well to both you and Robin. I haven't had a chance to do that yet. But looking out into the sort of the growing potential black swans, China's challenge with a second wave of COVID seems to be not an insignificant little moment. What's your read from Singapore? You're on mute, Leo. Sorry, just to remind you to unmute. Yeah.
Sorry for that. Happy New Year too. Yes, it's not insignificant, the increase in China, but on the other hand, there is enough optimism that the Chinese government will handle this rapidly and adequately. And get it back under control. And if you look at the total number of cases in China over the last year, was 100,000, which is pales in comparison to anywhere else where it's, the virus ran out of control. So I think there's enough optimism that they will get it under control very quick through restrictions, travel restrictions, lockdowns, and hopefully get back on the path of growth that they have set in onto. Where they expected this year's growth to be back up to 8% GDP growth. Other parts of Asia is more worrying. I mean, the state of emergencies in Malaysia, Indonesia are being expanded now. I think there's a growing sense of reality actually setting in that it is not under control in those countries. Philippines probably the same. So that is more worrying in this part of the world. Singapore is pretty much under control. It's of course a small country, but pretty much under control. Even though one of the government ministers yesterday came out and said, don't expect this virus to be away in the next 4 or 5 years. That's what he was expecting. So I think there's a sense of reality and a sense of optimism that we will get back into a growth path and not back to normal soon, but at least back into a more optimistic environment.
And Leo, from the point of view of flow of oil, storage levels in Singapore, flow into China, everything looks normal, coming off a little bit. What's the general volumes looking like?
Well, if you look at what China has been doing in December, the refinery throughput in December was practically unchanged from the month before, but imports were down with a stable domestic production. So that means that they've been eating into the domestic stocks. And I think that's a trend that we could continue to see going. The floating storage is practically gone. In fact, there's now talk again about an increase in VLCC scrapping. Scrap value is the highest in 3 years. Even though we had seen practically no scrapping in the last 2 years, I expect that to come back again this year. Net earnings on, for instance, Middle East to China net earnings is negative now on the VLCC. So there's an incentive to take the older vessels off the market. Other flows, when you look at refining margins, for instance, maybe you see that the refining margins in the US are the best in the world. That here Singapore refining margins are slightly negative and are not improving. ARA margins are slightly in the positive, but also not improving. So there's, except for China, there's that flow will continue to go. And China will continue to grow their domestic consumption and their imports as well.
How did I go on to mute? Paul Young, Head of Energy Products at Dubai Mercantile Exchange. Good morning. I see you're sitting in front of my old office. I literally can see in the window nearly, where I spent 6 years in that building behind you. Paul, welcome back to the table. The outlook at the moment for prices, are we getting stuck in the same space that we were most of the second half of last year, sort of low 40s, give or take $1? We now seem to be stuck on Brent 55, give or take $1, a few cents up, a few cents down. There's nothing really there to move it either direction.
Yeah, very fair point, Sean. I was just looking at the chart there. For the last, 3 weeks, DME or man anyway is 54 to 56. So a solid start to the new year. December average was exactly $50. So it's bumped up from here. There's probably only 20 cents a barrel difference between all the key markers, be it Oman, Brent, Dubai, even Murban. They're all pretty much parity. Small backwardation, 10, 20 cents. Suggests it's fairly balanced. Probably not a lot of immediate upside from here. But, as we hear every day, it's that battle between, lockdowns and demand impact on the one side and the vaccine stimulus packages on the other. So it looks fairly flat. The banks have got a little bit more bullish, though. I don't know if you saw the Goldman report the other day, $65 by July, where Barclays yesterday up in it a few bucks to 55 by the summer.
That's I suppose if the narrative continues as forecast, then the second half has that potential to recover. But I don't see yet, at least, the markets reacting to this increasingly uncertain news about the vaccine rollout. It may have stopped it from rising further, perhaps, but yet to really adapt to the narrative that is clearly shifting, I would say, on the outlook for that second half of the year. Paul, your thoughts on that?
Yeah, that's very true. We just heard refining margins are a little bit sluggish. We heard, I think there was a report, was it overnight for us, that US margins were the worst of the year in Q4. Can't really see them recovering with more lockdowns there. We've got more, certainly more restrictions. I think you now have to wear a mask if you go hiking in the Grand Canyon. So they may be finding skeletons in years to come still wearing masks. So you can't see the US recovering at any rapid pace until we get the vaccine rolled out. Europe, I think we've already pretty much, like I said, it is what it is. It's not coming back anytime soon. Relying on Asia. So as we just mentioned, you have to watch those Chinese lockdowns.
Is there, on the point of China, demand for Omani crude, which of course is always the strongest buyer of Omani crude, any let off of that? Is that looking consistently solid?
It looks fairly normal spot buying patterns. Not just for Oman, across the barrel. The teapots are there. There's a couple of new teapots. Well, I say newish in recent months. Still like stocking up, building inventory. But we heard yesterday on the Gulf Intelligence that it might be getting a little bit sticky there again. Some logistical problems. The other slightly worrying point is INE, which, if we recall in Q2, kind of led the price recovery among global markers.
That's right, yeah.
That dipped below Brent, Oman, I think even Dubai as well, in the second quarter, and that's pretty much, in the second half of last year, has pretty much stayed there. Even now, it's $2-3 under Middle East crude. So if you add, all right, freight's cheap at the moment, but storage is expensive in China always. So if it's $2-3 under FOB Middle East, and then you've got to add in the storage and freight, it's at least $5 offside. So, all right, you can say that's primarily a retail market, but not always. We saw something like 40 million barrels of spot R barrels sold into INE in Q2. Well, some of it delivered in Q3. So that has not recovered. As I say, it's primarily a retail market. But in the real physical market, the Chinese buying is holding up for now. But if we get that situation where demand drops off, we will get storage issues again that we saw in Q3.
Robin, your thoughts, I haven't had a chance to ask you, and it's related to where does supply go from here? Because as demand continues to look a little bit uncertain in supporting the market, supply becomes, I think, comes back a little bit more into focus. And the deal that OPEC Plus did in the earlier part of the month, where Saudi Arabia unilaterally took on the burden of an extra 1 million barrels a day of a cut. What are your views on that 1 million barrels? Do you think it will come back, or is that preparing the ground for possibly new supply coming from elsewhere? How do you see the supply alliance going forward over the next 2 or 3 months, now that we're trading March into April supply?
Yeah, I found, Sean, that move by Saudi was a bit of a concern because, we've so often said the Saudis wouldn't want to take on a unilateral burden of making cuts, and then they did. And I don't think they're going to want to persist in that or even make deeper cuts. And they also had to concede to Russia and Kazakhstan that yes, you can make increases in line as if we'd increased by 500,000 as a group, which we, as we had planned to. And I think that shows, obviously there were other members who were also pushing for that 500,000 increase, and the only way to square that circle was for the Saudis to make a unilateral cut and say, okay, we won't increase as a group in general, but by the Saudis cutting, the prices will be higher, so everybody else will benefit. But I don't think that's a trick that can be repeated. So they will really be hoping the next meeting that the evidence is good enough that there's enough market recovery to add 500,000 and get back on that track. I think that'll be quite important, because again, if the market isn't good enough and there isn't room for that 500,000, the Saudis have to persist with their cuts. Still, some of the other members are kind of champing at the bit to start increasing. Iraqi compliance is up for now. We'll have to see how much that persists. But we are seeing some challenges on Iran. Iran obviously not part of the deal, but very, very tricky to monitor. But I think there have been some signs that Iranian production and Iranian exports, I should say, because a lot will be coming from storage. But
as a long-time Iran watcher yourself, Robin, how are you reading the tea leaves on their posturing regarding the new administration? Do you think they're willing to play ball to try and get a deal?
I mean, on the oil side, they're trying to say that they're ready to go and not have all these plans to increase production. Obviously, that's kind of meaningless, and their sanctions are substantially relaxed. I think the Iranians can squeeze out a bit more oil into the market, but they won't get a major increase until there are negotiations. Yeah, look, I think that they are ready to talk, and they've always been ready to talk. But it's a question on what terms. And I think the Biden administration is still, it's either keeping its cards close to its chest, or it hasn't quite figured out its policy on this. Is it simply going to say, okay, compliance for compliance, go back to the JCPOA, restrict the nuclear activities, and we will reduce the oil-related sanctions, or are they still thinking of the kind of more for more, and still basically trying to trade off the supposed leverage that the Trump sanctions created? That's still not quite clear, and I think they have other things on their plate immediately. And I've always been concerned this Biden administration wouldn't get down to work on this immediately. They've got a lot of domestic stuff to do. And
also Iran has an election coming, right? So that's probably its ability to engage. It'll be interesting in some regards to see who the candidates are for the presidential election in Iran, and then what one can interpret from that in terms of their willingness to engage. Leo, coming back to Asia, and we've been talking, Paul just referenced it himself, about the outlook for prices into the second half, forecasts up to 60, 65. My question, Leo, is how sensitive is Asia demand to this rising price? We had the Indian Minister of Energy last week sort of quite vocal, complaining against the choreography to push energy prices higher on consumers in Asia. What's your outlook for that ability to continue those demand levels at prices creeping above 60?
I think the demand in India will probably be more price sensitive than anywhere else. I mean, it has been increasing. It's one of the few countries where the larger countries where demand actually has been on the increase and on good levels. But they will be price sensitive. But they have other origins as well. They have been buying a lot of Iraqi oil recently that can be replaced with Iranian oil again, the traditional one. So there are alternatives. And I think China, for the domestic demand, the consumption, I think is less price sensitive. What will happen is that the timing of purchases will change. I mean, they have been trading this very, very well over the last year. They piled up, stocked up, bought up all the oil that they could at the low levels and are eating into it at the moment. And that pattern you will see continue going even with higher prices.
Do you subscribe to the view that we had yesterday or earlier the week from China that there isn't really much spare capacity in storage for China to sort of consume or import on the levels that they did last year, at least until they've drawn down significantly?
That's right, and that's why you see them drawing down at the moment. I mean, the storage capacity is limited, even though there is a lot of new construction as well in storage capacity, especially in Qingdao, Zhuhai, those areas. But for instance, in Dalian storage is still full, and there's little room to further expand there. So they're eating into storage at the moment, and all the floating storage is gone, and that is going to be a trump card still, because they can bring back the floating storage again at any point.
If you get a contango market, maybe. Let's go to the survey question, and just to get a sense of the disruption that the vaccine rollout could be, or the sort of disrupted vaccine rollout. We're certainly seeing the vaccine rollout in Europe and America face some challenges, but we're not even seeing the vaccine emerge or arrive in developing economies. And the World Health Organization is increasingly starting to get vocal on the fact that there can be no global recovery until the vaccine reaches everywhere. So my question today is, can global oil demand achieve the 6 million barrel a day recovery in 21 that's forecast if we have a two-tier vaccine rollout where developing countries don't receive adequate supplies until 2022? Can we have just a developed economy, developed world vaccine recovery when the developing world won't see that until next year, at least in the context of oil demand recovery, the 6 million that's forecast? Paul, looking at more regionally here in the Gulf, the sort of outlook for the discipline we saw, the Qatar return to the fold in terms of the regional GCC organization, the outlook for sort of what that geopolitical position will mean going forward, with some of this potential for Iran to be re-engaged within OPEC. Do you see that the region is ready for that kind of rapprochement?
I think what Robin said there, we've got, Saudi is very much a supply side champion with that additional 1 million barrels a day cut. I took that as very bullish for the market, that the Saudis, come what may, are going to protect that price in the 50s unless something, a complete demand shift happens and we go back to where we were in Q2. But no one's going to factor that in. So I think the Saudis are saying, we'll go it alone, but we want support. Obviously,
there was some talk, commentary around the fact that the Saudis at the beginning of this journey cut from a higher level than the Russians. They did. Well, several countries did, inflated the production levels just before the cut. But that additional 1 million barrels a day is very real. Like, the nominations are down, so it is another 1 million barrels off the market. I think what they'll be looking for is Iraq, and we heard from Robin, they've still got those compensation cuts, are catching up. Libya will naturally fall anyway. There's some issues there. I'm not sure with Nigeria, perhaps could be a little bit lower there. And is there room for Iran? Yeah, of course, Iran wants to start pushing out more barrels. But with Qatar, I don't think they're going to re-engage with OPEC anytime soon. I don't think that's on the agenda. Who knows? There could be a nominal token cut as a nod, but in oil terms, Qatar is relatively small, so it's not a game changer in any way. It's nice that finally, after several years, that they've built or rebuilt a lot of those bridges, and hopefully it will continue. But I don't see it as a story for the oil markets anytime soon. Yeah, Robin, on that, but just picking up on the Qatar narrative, I would welcome your thoughts on gas. I mean, clearly LNG has sort of shocked the world on its price architecture over the last few weeks. And what are your thoughts on what's triggered that? What's its longevity, do you think, going forward? And is there a legacy impact given the scale is just off the charts?
Yeah, I mean, the spike has been crazy, of course, and there's obviously, just as usual, confluence of factors. The shortage of logistics, the pileup at the Panama Canal, a number of major LNG plants around the world being offline, and then a very cold winter in Asia. and a scramble for cargoes. And really Japan and China concentrate on those two countries. And you've seen, I think, what's interesting is how the driver of the LNG market has shifted, and how important Chinese demand is, just how dominant it has become. And and the Chinese growth will be absolutely key to the LNG market for the next few years. I mean, Japan, of course, can have spikes, but Japan, Taiwan, Korea, the traditional markets are stagnant or declining markets, but China is clearly where the immediate growth is. So long term, I think, well, this price spike, it'll be good for new projects. I think that the US projects look pretty moribund. Now I think there will be a lot more interest in trying to get some of those US projects up and running again, some of the new LNG terminals. It's positive for them. It's positive for some of the other countries like Mozambique, some other emerging new producers. And the Qataris, they've obviously got this very big LNG expansion underway. It's been a little bit delayed. They'll also, I think, be keen to forge ahead. I don't know, price spikes like this, okay, it's great earnings for the companies and for the traders. It's not a good thing for the market overall if it's going to be scaring people off using LNG, scaring off important new markets like India. Or
Bangladesh, Pakistan.
Right. I mean, Pakistan saw some people defaulting on cargoes, this winter, which is not a way to build a market.
Yeah, I mean, that's the consequence, I suppose. The legacy of this current impact is inevitably things like that. That's a burden, and blackouts, of course, where countries cannot actually afford to meet the added charge. Let's go to the survey result before giving Leo the last word today. Yes, can global oil demand achieve its recovery, 6 million barrels a day, without the developing economies? No, 56%, yes, 44%. So kind of a split room on that question. I do think it's something to keep an eye on. It's maybe not yet a central theme in the markets, but I think it's one to watch. Vaccine rollouts in general, but certainly in the developing economies. Leo, the outlook for the China New Year, should we keep an eye for any potential surprises there, travel, etc., on demand impact?
Well, it's the biggest people movement on Earth annually. That's the 3 billion people, 3 billion movements back and forth in a short period of time. Actually, it started earlier. I mean, Chinese New Year is about 2.5 weeks away, and offices, businesses have been starting to close down already. People are starting to travel because they want to reach. Having to stay in quarantine here or there, they want to reach the families in time. So the government is trying to dissuade travel, trying to put impediments on too much travel, but I don't think that will work. I think the Chinese will go to their families for Chinese New Year. That's the most important thing in the year to celebrate. And that by itself will be good for fuel demand, because the Chinese mostly prefer driving rather than public transport. So there will be a lot of movements in the next coming weeks. The government will keep a very close eye and a tight hold on further spread in forms of gatherings and lockdowns, etc. But other than that, I don't think we will see big surprises coming out of this.
Okay, well, let's wrap it up there. I think also to keep an eye out this week, and just seeing a reminder come up on the screen, our halftime talk interview this week is with the Minister of Energy for Egypt, Mr. Tariq Al-Mullah, and certainly good timing to get some views of his, not only from the point of view of the outlook for oil, but most significantly, Egypt are just about to become LNG exporters again, having been a few years out of that space. So watch out for that interview. It will be posted tomorrow. But thank you, Leo. Thank you, Robin. Thank you, Paul, for your participation and insights today. Have a great week, and we look forward to catching up with you all in the coming days. Thank you very much.
Thanks, Sean.
Thank you.